Good evening. I'm your host, Matt Williams. Today is Monday, March 17th, 2008, and it has been an absolutely ridiculous day as far as the markets are concerned and as far as Wall Street is concerned in specific. Now, of course, that means that mortgage rates are also having a wild day as well. Now, this morning, it was announced that JP Morgan Chase is actually going to take over and buy out the troubled Bear Stearns. Bear Stearns was the largest holder of subprime mortgages in the United States and topped out at about $150 a share in a 52-week average, and they're just being sold for $2 a share, which means that they were basically completely insolvent, and so they were picked up at 3 cents on the dollar. Now, the other news that is breaking over the weekend is the Fed had an emergency cut, and that was done during the weekend. Now, the unusual thing about that is the Fed usually has cuts on scheduled dates, and sometimes they have emergency cuts. But they don't have cuts over the weekend unless there's something very strange going on, because they haven't done it in over 30 years. And they cut the overnight lending rate by 1/4 of a point, which brings the overnight lending rate, which is what banks lend to each other for in terms of an overnight basis, much closer to the prime rate, and the prime rate is being cut as well. And that's both good and bad depending on where you're sitting. The nice thing about it is home equity loans, car loans, and other things are going to improve in terms of their pricing. But the funny thing is, long-term mortgages, such as 30-year fixed, at least on the last 6 cuts, which have happened over the last 6 months, have actually taken negative after each substantial cut. Now, because of the increased volatility in the market, it's almost like a motorcycle that's going down the street and starts to get the wobbles and starts to keep the wobbles and goes farther and farther out of control. Well, right now, we had over 150 points in gain on mortgage-backed securities, which means that mortgage rates are actually improving. Now, the interesting thing about this is, if you look at it, it really does hold the true analogy of a motorcycle just rolling down the street and starting to lose control. Or a skateboard, if that analogy is a little bit less graphic. But really, to give you a clear picture, this right here is the last 6 months of mortgage-backed securities using the 50, actually this is using the 6.0 average of the Fannie Mae 30-year backed mortgage securities. Now, what we have here is we have these little gyrations where we went down and then up and then down and then up, and you can see they're getting wilder and wilder until we reach where we are today, where we're pushing up to our highest point in 6 months. Now, the 25-day moving average is really considered a leash, and what this does is quite often you'll see that the market will deviate from this green line, which is a little difficult to tell. I'll throw one up on screen.
Now what you're seeing here is the last 6 months of market movement in terms of rates on mortgage-backed securities. What that means to you is the more of a decrease you have in value, the more expensive rates are. So this is almost an inverse to the 10-year Treasury note, which is what a lot of people watch. So just to give you an idea, you want this to be as high as possible because that means rates have gone better. So again, when we're talking about that 25-day moving average, that's going to be this green line here, and you can see how rates continue to snap back down to this level on a continuous basis.
The truth of the matter is we bounce back up off of that 200-day moving average and continue to climb higher. Now, the 200-day is a very important average because it really shows either a floor or a ceiling depending on which side of the ledger we're on. So if we're below the 200-day moving average, it's hard to get through it again, which means that mortgage rates are going to continue to worsen, typically, if we're stuck under it. If we're above it, the odds are better if we can continue to bounce off it, then things will gyrate in a positive direction. So it's one of those important technical factors that you want to look at, where most folks tend to look at the 10-year note or other factors that just aren't as important, because that's basically looking at yesterday's news instead of tomorrow's news, which is a lot more predictable when you have the numbers in front of you. A couple of other interesting points. 5 years ago, starting this, I believe it was Tuesday, no, this Thursday, the war in Iraq began in the early hours of 3/20 of 2003. And we're We're still trying to work our way out, but we're approaching the 5-year mark as of tomorrow. Now, beyond that, we've had a loss of jobs in the United States economy, which typically is good for mortgage rates because it shows that you're having a higher rate of unemployment, which isn't so good if you're left without a job, but it is good if you have a job and you're trying to refinance your home, or you're trying to purchase a home for that matter. The other technical factor that's been really the largest impact on the market has been the price of oil. Now, if you've picked up a newspaper or you've turned on the television in the past few weeks, you've definitely seen some of the impact that the words inflation and oil prices per barrel have on the economy. Now, we've actually hit the record of $100 a barrel, and since then we've set 9 additional closing records, and the highest was ending last Thursday at about $110 a barrel, a little over $110 a barrel. So there's a lot of things up in the air. Some are good and some are bad, but the truth of the matter is everything is including greater volatility in the market. So I'll keep you posted as things continue to unfold. There's also been some new FHA limits and a variety of other important announcements that have come by, depending on where you fall in the niche of buying a home, refinancing a home, or just looking at the markets and wondering what you're going to be doing the next 3 to 5 years. And we'll speak about that a little bit later this week. But as for now, have yourself a wonderful evening, and look forward to tomorrow. I'm sure it's going to be another interesting day with the Fed scheduled to probably cut rates probably 3/4 of a point is what the market is averaging in terms of their estimates. And with their cut of the weekend, it might be more, or there might be something else going on that the rest of us aren't aware of. But we'll find out tomorrow. So have yourself a wonderful evening. Take care of yourself. If you're in the Denver area, drive safe. The snow is abated, but it still might be a little slippery out as things start to freeze.